May 8th, 2026. Imagine standing on a bridge where the ground on one side is worth $1 and the ground on the other side is worth $2, yet every mainstream analyst is telling you the price is exactly the same. Right now, a silent financial earthquake is shaking the very foundations of the global economy, and most people are looking in the entirely wrong direction. For decades, the West has controlled the price of silver through paper contracts and digital ledgers, but a massive disconnect has opened up in the East that is about to change everything you think you know about money. This is the story of the Shanghai Arbitrage, a phenomenon that is draining Western vaults at a record pace and setting the stage for a price explosion that could redefine wealth in our lifetime. Before we dive deep into the mechanics of this collapse and what it means for your portfolio, make sure to hit that subscribe button and turn on notifications because the window of opportunity in the precious metals market is closing faster than anyone anticipated. We are Metal Market Insight, and today we are uncovering the truth that Wall Street is desperately trying to keep quiet. The reality of silver today isn't found on a computer screen in New York. It is found in the physical delivery hubs of Shanghai, where the metal is trading at a massive premium compared to the London and New York markets. This gap, known as the Shanghai Arbitrage, is effectively a giant vacuum cleaner, sucking physical silver out of the COMEX and into the hands of Eastern buyers, who understand the true industrial value of this metal. In the United States, we have been told for years that silver is a boring industrial byproduct. But while the West was sleeping, the East was building an empire based on physical reality. You see, silver is the most conductive element on Earth, and in an age of artificial intelligence, high-performance computing, and a global shift toward renewable energy, silver is no longer just jewelry. It is the new oil of the high-tech revolution. Every single AI chip, every solar panel, and every electric vehicle requires silver that cannot be easily substituted. Yet, the price discovery mechanism in the West remains stuck in a world of paper derivatives that simply do not reflect this physical scarcity. As we sit here in May 2026, the inventory levels in Western vaults have hit a critical danger zone because traders are buying silver low in the West and immediately selling it high in the East. They are pocketing the difference while the available supply for American investors evaporates in real time. This isn't just a market fluctuation, it is a fundamental shift in the global balance of power. If you are finding this breakdown of the silver market eye-opening, pause and leave a comment below right now. Do you believe the COMEX is truly running out of silver, or is this just another cycle? Your insights help us navigate these volatile times together. The reason this matters so much to the American audience is that when the physical metal is gone, the paper price will be forced to converge with the physical price in a move that will likely be the most violent upward correction in the history of the metals market. We are talking about a scenario where the price doesn't just climb, it teleports to new highs as short sellers are forced to cover their positions in a market that has no physical metal left to give. As we've seen recently, silver has already tested the $120 range, and while the mainstream media calls these bubbles, the underlying math tells a different story. The industrial superdemand from the AI sector is the hidden catalyst that no one is talking about. While the mainstream media focuses on stock market volatility and interest rate hikes, the physical reality is that the world is consuming more silver than it mines for the 6th consecutive year. China's recent decision to reclassify silver as a strategic material and restrict exports, allowing only 44 state-certified firms to ship refined metal, was the final nail in the coffin for the old pricing system. They are effectively locking the gate and keeping the world's most vital industrial metal for themselves, leaving the West to scramble for the scraps. This is why the Shanghai premium isn't going away. It is the new floor for the market. If you know someone who is still holding all their wealth in paper assets, make sure to share this video with them right now. Understanding the difference between a digital number on a screen and a physical asset you can hold is going to be the difference between those who thrive and those who are left behind in the coming decade. We are witnessing a fundamental transfer of hard asset wealth from West to East, and it's happening right under our noses. The end game of the Shanghai Arbitrage is a total decoupling of the market. We are moving toward a world where there will be two prices for silver, the fake paper price you see on the evening news, and the real physical price you have to pay if you actually want to hold the metal in your hand. At Metal Market Insight, we have been tracking these flows meticulously, and the data suggests we are approaching a breaking point where Western exchanges may be forced to settle in cash because they simply do not have the ounces to fulfill the delivery contracts. A historic default of this magnitude would send silver into a parabolic move. As we wrap up this deep dive, remember that in a world of infinite digital printing, the only things that truly hold value are the things that cannot be printed. The East has made its move, and now the clock is ticking for the West. Stay focused, stay informed, and keep a close eye on those vault numbers. We'll be here to guide you through every step of this historic transition. To truly understand why the Shanghai Arbitrage is a death knell for the current system, we have to look at the plumbing of the Western markets, specifically the COMEX and the LBMA. For decades, these institutions have operated on a fractional reserve basis. Imagine a bank that has 100 people claiming they own a gold bar, but the bank only has 10 bars in the basement. As long as no one asks for their metal at the same time, the system works. However, the data for May 2026 shows that for the first time in history, the registered category, metal that is actually available for delivery, has plummeted to levels that can no longer cover even a fraction of the open interest. When the East offers a $15 to $20 premium, they aren't just trading digits, they are demanding the physical bars, and this is forcing a bank run on the world's largest silver vaults. Let's put this into a historical perspective so you can see the scale of the move we are anticipating. In 1980, when the Hunt brothers attempted to corner the silver market, the price moved from $6 to nearly $50 in a matter of months. But back then, the world didn't rely on silver for its very existence. In 1980, there were no smartphones, no massive solar grids, and certainly no AI data centers consuming megawatts of power. Today, the industrial demand is inelastic, meaning companies like Nvidia, Tesla, and First Solar must have the silver regardless of the price. If the price goes to $200, they still have to buy it to keep their assembly lines moving. This creates a perfect storm where investment demand is fighting industrial demand for a dwindling supply, a scenario we have never seen in the history of modern finance. Many people ask, if the physical supply is so low, why hasn't the price already hit $500? The answer lies in the murky world of leasing and rehypothecation. Central banks and large bullion banks often lease their silver to market makers to create the illusion of liquidity. This silver is sold into the market to suppress the price with the promise that it will be returned later. But here's the catch. You can't lease the same bar of silver to 3 different people once that bar has been melted down and turned into a silver paste for a solar panel in Jiangsu, China. The physical metal is being consumed and destroyed industrially, making it impossible for these leases to ever be repaid in metal. And we are approaching the day of reckoning where the lenders are going to ask for their metal back, and the vaults will return an empty echo. Let's look at the numbers as of May 8th, 2026. Global mining production has plateaued, and in major producing nations like Mexico and Peru, political instability and declining ore grades have led to a 7% year-over-year drop in output. Meanwhile, the Silver Institute reports that industrial demand has surged by 22% in the same period. This is a mathematical impossibility. You cannot consume 1.4 billion ounces of silver a year when you are only mining 800 million, and the scrap recycling only provides another 180 million. The gap is being filled by existing vault stocks, and our tracking at Metal Market Insight shows that those stocks are now at their lowest level since the late 1960s. We are literally eating our seed corn. And once the cupboards are bare, the price discovery will be absolute and uncompromising. To my American viewers, this is the most critical point. The US dollar's strength has historically allowed us to import whatever we want, but in a world of resource nationalism, currency becomes secondary to the physical resource. If China and the BRICS nations decide that silver is a strategic asset, they won't care how many dollars or euros you offer. They will simply refuse to sell. We are already seeing the first signs of this with the new export licenses required in the East. This is no longer a free market. It is a controlled scramble for survival. If you're not positioned in physical assets before the cash settlement notices start hitting the COMEX, you may find yourself locked out of the greatest wealth transfer in human history. Disclaimer. The information provided in this video by Metal Market Insight is for educational and informational purposes only and should not be considered financial advice. Investing in precious metals involves significant risk. Always consult with a professional financial advisor before making any investment decisions.